Hello, ladies and gentlemen, and welcome back. Well, it happened as we expected. The trend line, the 200-day SMA, and of course, the call walls were too much for the market. And ahead of trillions of dollars of expiration, we've moved down to fill the gap. But as we move into this session, we have to ask ourselves many questions. Yes, we knew that retail traders were feeling FOMO. At the same time, we also saw the resurgence of SPACs and many 2020 and 2021 icons. But now ahead of the trillions of dollars of options expirations, there could be still a chance for a little bit of a rally. Let's discuss everything that's going on with stocks, commodities, and cryptos right now. Well, welcome back everybody to the Daily Show where we talk about markets. We've got the news, the macro, the lead indicators, and of course the key levels that you should be watching for all markets right now coming up in the show. But this was the worst day of 2023 so far, the biggest red session. And it happens right at the point that we thought it would, which is fantastic because it gives us opportunity to say maybe the markets are working quite technically. Now, there has to be a reason. So the reason was supposedly weak economic data, the core retail sales, and some hawkish Fed comments. Let's have a quick look at those. The retail sales numbers were out in the morning. They dropped 1.1%, basically a second month in a row of dropping. And it was forecasting, of course, that this would continue to weaken as these interest rates and the hike start to take effect on the American consumer. Remember, the American consumer is 1/3 of the US economy. So it's a big deal and it will take an effect to the GDP numbers later on as we see these things come through. Now, what was probably most interesting though, was we saw that the Fed came out again and our good friend, old James Bullard, came out and said, look, the Fed's still got to get hikes above 5%. Now, bonds markets and the Fed are disagreeing with each other here, and we'll take a look at that a little bit later in today's video as we look at the charts. But I did want to mention, of course, something we have also been covering here on the channel, and that is a very rare signal or very decent signal that used to be used and I think is still very consistent with one of the reasons that you usually believe a new bull market rally is in. And yes, it is thrust and of course breadth indicators. Now, when we tend to get these in markets, they're always, well, they're not always, but they do tend to be, consistent over the longer run with beginnings of new market runs. Now, of course, there's always, open or opportunity for things to be wrong. And even this indicator is wrong sometimes. But look, this is why it's important to have more than one reason for getting into a market. You need quite a few data points. When you start to see, let's say 4 of your 8 that you've selected or 3 of the 6 that you've selected, then you can start to say, maybe I want to be entered into the market in a bigger way. We will be talking about some of my ones moving forward on the channel throughout 2023 as we see this market unfold. So make sure to subscribe for that if you're interested in that content. Dumb money, inflow, confidence. Now, this is, of course, retail traders. You, me, everybody out there is probably watching this video right now. We were starting to feel the FOMO. In fact, dumb money confidence, which we've been covering here for pretty much all of 2023 so far, saw a 1-year inflow peak. So we actually made a new peak on dumb money inflows. Now, I shared this over on our Twitter. Follow at FX Evolution. Links in the description at the top down below. And what you'll notice is that when we tend to get these peaks, we usually have a shaky couple of months. Now, this is in line with a few things. Number one, we've got earnings season right now, but I'd also like to see the Q1 earnings coming out later on and possibly that to be the disappointing ones. So the next 3 months, historically, when we've seen readings like this, the market's been flat to down. And in fact, it's been generally down. Now, if you know anything about markets, you'll know that about 60+%, I think it's like 65% of the time plus, markets are up. So any stat that shows you less than 50% is usually pretty good to look at. And that usually tells you that there's some serious concerns in markets. So we've seen dumb money inflows certainly start to peak. And that means that retail traders were trapped. And what were they trapped in? Well, it's 2021 and 2020 all over again. Look, my most hated sector of all, SPACs, were the second best performing over the last couple of days. We've been reporting on the fact that the market's been going up on things like this, but I think this just really brings it home. Take a look at some of these LiDAR, EV chargers. Of course, we've got AI concepts, which I like very much, but AI concepts also high kind of growth, high PE stocks. solid states, hydrogen energy, Wall Street bets, as in a sector selected from Wall Street bets. Shout out if anyone's out there, I guess, on that one. Number 16, you made it in the list. And then, of course, ARK K, cruise concepts. So a lot of the resurgence of basically, you know, some speculative stuff and, of course, squeeze stocks coming through. So it's no little wonder that this is a great way of looking at the market and seeing those inflows coming in. So what about some other projections for 2023? Well, before we get into the charts, I just want to talk about a few. Obviously, we've got Goldman Sachs' thoughts process here. They believe that there's a soft versus hard landing scenario. Basically, that is, how does the Fed end up dealing with all of this? Does everything work in the Fed's favor? If it does, they actually believe we retest basically the lows, 3,600 within the next 3 months. Within 6 months, we make it back to something like 3,900, 4,000. And by the year end, we basically end up where we are right now, around that 4,000 level. Now, in a hard landing scenario, like most others, they're predicting that 3,200, 3,250, 3,150 area, which puts us back into wiping everything off from COVID. Now, if that does happen, you've got to be ready and you've got to have a plan. So just remember, for 2023, have a plan, know what you're looking at in markets. There are a couple of stats that we'll certainly be looking forward to. This is just another breadth and thrust kind of indicator. Again, interesting that we've seen a reading like this. Is the Wall Street boffins getting a little bit smarter? Are they getting a little bit smarter? The algorithms starting to play the game to set some of these off. This historically, again, has been very, very good. There have been some bad readings where the next 1 month to 3 months has been poor. But historically, other than one outlier here in 87, when you've seen these breadths again, you've got to look at the 12-month scenarios and say things are looking a bit better. Speaking of 12-month scenarios, this is another triple combo that people put together a lot. It kind of saddens me in some ways that we're not the only community talking about this, because often when it becomes so well known, it doesn't work as well anymore. This has been one that I've used for a long time now, and it's the Santa Claus rally coupled with the first 5 days, coupled with, of course, a January return being positive. Now, if you actually, I didn't used to do it this way, but if you actually put it with a negative year, because it's been so rare we've seen negative years, the next year's in this year, 2023, turns out to be a stellar year. So look, I think we're up about positive 2.3% on January so far. We've still got a few more trade days to go. So, and we've got the January expiration happening. So that might allow some further sellers to come through. So interesting times ahead. Certainly something we'll be watching and covering. We want to know where January closes. It's going to be important. Fear Greed Index did drop a little bit. It went from being in those 60s down to 57 in just one session. Just shows you how fast markets can move. And let's now have a look at something else for 2023 you'll want to keep on. I'm not going to harp on about this because I say it all the time. I think forward PEs will be interesting to watch and interesting to keep updated on. Again, subscribe to the channel. I'll update these figures throughout the year, and that will keep us in the loop of when things are materially cheap or expensive in markets. It's going to be a good one to look at. What about flows, though? Usually we've seen when we've hit market tops, staples, utilities, and healthcare doing well. That has not been the way. Look at the one-day flow here. XLP, XLU, and even healthcare, they were some of the worst performing sectors on the session. If you actually think about it, consumer discretionary and tech were down a lot, but they weren't actually down as much as the other ones. Interesting. If we look at the 5-day, it's again XLU and XLP down the bottom. And this is a little bit of a cause for concern if you're trying to be a bear that wants to push the market down right here, right now, and make it rip down. You traditionally, when we've rallied every other time, we've seen a movement into defensives. We're going to need to watch that very closely over the next week. Look, that's traditional. It's something we like to see. Again, having parameters is important. Ahead of earnings, we've got the big one, Netflix, coming out on the Thursday session. This is going to be a massive, massive earnings report. As we know, when Netflix comes out, that will give us quite a lot of inkling on what's starting to happen with the technology. Then we've got Tesla kicking things off massively next week. So that's when we get into those tech. And tech is going to be the most important thing to earnings season. We've seen a lot of the banks, they were mixed. Then we move into the next one. Let's jump into the charts. Start off with the VIX. VIX did spike. You'd expect it to spike if you had a down day like we did with pretty aggressive selling. We're back above 20. VIX traders obviously looking for that high. They're looking for that 33 plus sometime in Q1 in the markets. Remember, Q1 and Q3 tend to be the spiky times for the VIX. And if we're going to fall off, it's probably going to be those periods traditionally. Japanese yen. Now, I want to talk about the JP10Y. Of course, the Bank of Japan came out, and in some ways they surprised the market by basically saying, look, we're not going to change anything. We're going to stick with our policy. And this was really a positive for TLT, for treasuries, and potentially for the US dollar as well. So basically, if anyone doesn't know, Japanese people tend to be incredible savers. They send a lot of money overseas. They've traditionally invested in US treasuries in Europe and things like that. And because we haven't seen the raising of the yield cap, effectively, we had a great day for TLT, and it was a fantastic session, 2.42%. The whole Japanese thing, in some ways, pushed it down to the levels where we saw it. And it looks like TLT is kind of poised for a new high. We've thought this is probably going to be one of the better investments of 2023. It's back to that old playbook of we're in basically a deflationary bust, a recessionary period. During those times, traditionally, treasuries, especially US treasuries, have done relatively well. And it was a nice, strong day. There's still a lot of gaps left behind, so I wouldn't be surprised if it does something like that. But realistically, you're starting to think about, well, new highs could be coming in for treasuries. Why is that? Well, look at this US 2-year. The US 2-year dropped, and this is where there's a crisis between the Federal Reserve and basically the stock market or the bonds market. We got a new low on the 2-year, but take a look at this. By April of 2023, we're only expecting 4.76. Now, that's interesting because even by September of 2023, we're expecting 4.76 basically. So the market's saying, you know what? We don't believe the Fed can get above 4.75 to maybe 4.8. Yet the Federal Reserve saying, no, we're going 5% plus. Interesting. This is a storyline for sure. And it's a fight between the Fed here and the market. The market truly doesn't believe that the Federal Reserve can do any more damage to the economy without tipping the scale, clearly. And they're calling their bluff. So we'll find out who wins this one. They say don't fight the Fed, but well, we'll see what the Fed really truly does. Are they calling the bluff of the market and the market sniffing it out? Be interested to see your comments down below. Let's have a look at the US dollar. Oh, they're sneaky. This is really nasty. So you'll notice over here, and I'm saying this because we end up getting a new low and then a really heavy rejection on the US dollar. So obviously around here, we've been talking about how we're on incredible demand. Sentiment has shifted towards, I would say, weakness in the US dollar. The articles being written are all now, the US dollar's gone. It's cooked, all those types of things. But we saw a new low followed by pretty large demand. Could this be some type of Wyckoff accumulation bottom? Effectively, this being that UTAD, this being that selling climax kind of situation where we're effectively seeing max pain and the market pushes forward. We've had many interesting signals here. Of course, we had that bullish move after the Bank of Japan came out. We pulled back as expected. Around here is where I was hoping we'd see rallies, and then it swiftly takes those lows and then just instantly rejects. That's symptomatic of some inflows coming in, and also a lot of people getting hit here with stop losses if they didn't use the right tool for the job. So, of course, futures traders may have been stopped out in a trade like this. If we get new highs, which I'm going to set a new alert for, so that's that 10268, we've got to seriously consider the possibility that the US dollar is actually shifting. Now, of course, we don't know that yet, but certainly an inkling there after that big rejection off the low. That shows us there was demand. And when we've seen that in the past, we tend to get sideways to upping markets. Even over here, you see that big shift in demand. So expect the US dollar to either sideways or start to roll pretty heavily here. The euro did the same thing. You'll notice here the euro took the highs, then bang, straight back down. It was a tough session. Big moves on the euro, up, down, up, down, up, down. For currency, that was quite wild. I was watching along with a lot of you. I could certainly see why we rallied. I thought probably in here is where you would see the weakness, and then you just took those highs and then came down. And to me, that's that sign of trapping in the market. So again, could this be the UT or a UTAD style situation? Time will tell, but if we get new lows, it's starting to look a little bit sneaky there. What about gold? Well, it hit our demand level and absolutely rallied, but it didn't make a new high. And of course, it started to weaken after we saw strength in the US dollar coming through. Gold at a precarious position. Everyone's bullish on it. The inflows have been pretty good for it. Obviously, the storyline's been exceptional. Watch around this demand zone. A new low being formed here. I think that's going to be an important time. If that does happen, we might rally again, but it looks like probably 1870-ish, 1875 would be the next target. So watch in here. At the moment, it's still bullish. There's no signs of bear just yet, other than just a little bit here. But when you put it in perspective of a daily close, again, look at that. Lots of rejections. For you, if you're in gold, all you're hoping for is a new high, because that'll be putting this squeeze on so many people that will be shorting through here. So new high, you'd be like, wow, that thing's going long. At this stage, we know where our demand is. We know where our secondary demand is, and we're looking for the signs. Remember, be patient, react, don't predict in these situations. If possible, we know where the key levels are. Let's watch and see. Oil took a bit of a nosedive. I've been talking about shifting to the upside here in my potential thought processes moving forward. I've long talked about 65. We're at that critical level. I'm looking for this to break out. I want to then see $90 a barrel. We've obviously moved down to this demand low. I've got an alert set there because if that happens, you could make a case for further shorting to happen on the short time frames. I'm still thinking, though, potentially oil into 90. We'll play it out as we see it. I'll come back to oil when we see more. Let's move over to Tesla. Now, I didn't update the 24-hour expected moves here for Tesla, but I wanted to show you, look at that. Gap filling in here, or pretty close to. That was the expected high, and it slammed into it in the session and then fell off. It does show you why these can be correlated together. And when you start to stack them on top, it can work out decently well. 133 and a bit is where we've got the new expected high. And we've also got 124 for the close. So 124 should take us, not quite into the gap fill, but if the market continues to sell, there's a real chance that Tesla would move down to that 122 and then maybe rest on 124 by the end. So watch these levels. The market's expecting that Tesla will remain in here 68% of the time, but I did want to show you those highs getting taken. There's not too much to really state on the option side here for Tesla. We've still seen realistically the highs coming through. Let's have a quick look at it together. We've got those 130s and 125 calls outpacing the puts, and we've got the 120 puts outpacing the calls. So in a perfect world, we've seen the stock price here, max pain 131. We would basically remain between 120 and 130 by the end of this week. And look, these poor puts, sad face for them, but luckily most of the guys in the community here, I'm sure you didn't make that mistake. It's always important to consider these options, and these people, they're wild, the 200. So sticking between 130 and 120, you would think is probably the most likely scenario. And then, of course, trading intraday within those parameters to a degree. Let's move over to Apple. Rejection week here. Nice little rejection candle, but Apple's not really the true story here. Weekly will be interesting to see how that closes, so we'll continue to watch that. Piton. I wanted to bring this up. I did bring it up in the private community ahead of the stream. If you're ever interested in that, free 7-day trial down in the description below. But basically, we had so many upward trade days. We basically had 1, 2, 3, 4, 5, 6, 7, 8. So it was 8 of 9, and even this was a doji. Trade days up. Well, it was time for a bit of a sell-off, and that's what happened. Pretty rare to get that many up. Again, it was just showing that FOMO coming into stocks that were heavily shorted. AMCs, BBY, all of those types of things were squeezing. A lot of hyper growth stocks, they hit some resistances and they potentially sold off. The same thing happened with the Russell 2000. It hit the zone that we had highlighted. And it was sneaky because it went long in the session and then just shorted straight off. So even the Russell 2000 had the traps in it. If you have a look at it, there it is. There was the take of the high. And then it was just short after it had basically got buyers to commit, and then it squeezed them all. The S&P, again, was the one we had to look at to keep us sane in a very tough session. UK 100, I'm just bringing this up just so that we can think about this being a potential false break question. We don't know yet, but if we go into a really bad year, then if this starts to take out these lows, we can start to guess that this is all part of a very scary distribution. We're going to return to this chart if necessary to do so. US 100 hit into our pocket and then sold off. Another one that had that early trap followed by just super aggressive selling. And it was really just the day that the S&P 500 would save you here. Let's move over to the S&P. We still have all of our unfilled gaps everywhere. As we know, we're heading towards the 39.18 one, which was always our target. 39.40, 39.18. These are the two targets we had in the short. Let's move over to the expected moves now. Here you can see 387, 395 by Friday close is the expectation. So certainly remaining in an interesting area. And I'm kind of favoring the idea of maybe some selling into a buying procedure. And we'll talk about that in just a second. Let's move over to the futures. Now, this is where you got saved by just looking at the S&P 500. This was our key zone. Once that was broken, 39.40, super likely. 39.20, likely. At the time of this recording, it looks like we're going to open up and gap fill. So that's pretty important. We've also made a new lower low underneath this area. I'd actually love to see the market, though, take this zone out because we did see some buyers. Then they showed that they were kind of doing something in here, probably accumulating a position. And then that broke a very heavy structure break here. And then we had some pullbacks. So these are the obvious ones. I would like to see it take this and then pull up. So we might do some fib pulls in a second together just to have a look at what's some interesting scenarios. But the key was to understand that this was the higher high. The S&P 500 did not trigger buyers on this day. Thank goodness for the S&P 500, because if you were watching the Russell or the Nasdaq, you got shellacked buying in. Whereas the S&P 500, it protected you by being the better rounded index in this case. And once it fell through that area, as we suspected, these levels, and you can even see that they were correct because look, there's a little bit of consolidation here and it's dropped through after hours into this zone. So let's pull out a fib here and just load up a couple of things. So we're just looking really at some key zones, and we're just understanding that if we did have a pullback right now off this level, what you might notice is that this would be a very interesting zone to come back to, that 39.80. So I'm kind of favoring, look, there is a downside potential here to that 38.66 kind of zone. If it keeps falling off, that's the area that you're probably going towards. But at this stage, 39.80 also very, very key. So I like around this zone. I wouldn't even mind it to go a little lower, pull back up to 39.80, and then to see further bears recommit. This is certainly a bearish tinge to these markets though, and it could load through once we've got the options expiration. I'll explain that now. So here's the options expiration, max pain 391, big moves each way, stuck in the middle of both zones, unlikely to close too much below 390 this week. You can see all these puts unlikely to make too much money. And the reasons weren't that, I mean, look, there's no reasons. Core retail sales, sure, it's probably already expected. And Bullard's comments, come on, that's the same thing the Fed's been kind of saying for ages. We're going to make above 5. We're going to do above 5. And it's always used as an excuse. But what it proves is that these news stories or these articles writing out there to come up with a reason, I don't care about the reason. What you're needing to think about is the true reasons. And the true reasons is pretty much manipulation of flow. So here we are stuck within two boundaries, 390 and 400. If we do like a little sell and then start to recover, would that be perfect for Wall Street and the composite man? Yes, it would. Let's move forward to the week after the 20th. So we go towards the 27th. Now we have 5.3 million units open. Then all of a sudden we move into the next week. I'm not sure what these are, but basically we only have 706,000. So a big difference here. And you'll notice there's real room for further downside, 380s, 370s, and it could even go all the way down to, I mean, theoretically it could go to 350 and not really cost Wall Street and option sellers that much. So lots of room for shenanigans into the end of January. Remember, positive ends of January or positive Januaries tend to lead to those trifecta years where you have a positive year. Many people are looking at that. Will we end up getting a negative January? It's certainly something to discuss. Let's move over to Bitcoin. It continues to hold the line on this 61.8 kind of golden fib pullback. We're in that critical zone. We saw a sell-off on it. Let's have a look at the 2 hour. Did we get a new low? So we didn't quite get underneath here. We got under this level, and it's look, you can see the rejections around here. You can truly see that people have been selling there. And I think that's a beautiful location for day traders, for traders that have been in there for the swing. I don't blame them at all. No new low, so we're not underneath 20,250. I probably would have liked to see that get taken. And we'll just basically realize this is with the stock market at the moment. So if it falls through again, then possible pullbacks. Even now, it's possible to pull back something to a 21.25, put pressure on this area, and then maybe sell off. You'd probably be on the negative end of crypto at the moment at these levels, though. Yeah, it's not highly statistical. You're not seeing like a super entry, but you are seeing a very interesting exit point for those day traders. Let's move through the news. Nothing much coming up. Obviously, it's earnings season. A whole bunch of lower space news, but we do have FOMC members coming out and saying their things, and ECB presidents and all of those types of ones. I wonder why they put them all here. It seems like they're all put on pretty consistently just to have a chat about the economy and to try to convince the market of one story while the market decides its own. If you've enjoyed today's video, then please remember to subscribe, smash that like button, guys. It really does help us out. And we look forward to seeing you in the next video. Bye for now.